Imagine needing $400 before payday. Your car breaks down, rent is due, a medical bill arrives, groceries cannot wait, a bank will not help, a credit card is maxed out, family cannot lend, and the emergency is happening now. Then you see the offer: fast cash, no complicated process, money today, just pay it back when your paycheck arrives. That is the promise of a payday loan. And for many people under pressure, it can feel like a lifeline. But the problem with payday loans is simple. The money arrives fast. The trap arrives faster. A payday loan is usually a short-term loan designed to be repaid on your next payday. It may look small compared to a mortgage, car loan, or credit card balance, but small does not mean cheap. In fact, payday loans can be some of the most expensive money in America. The cost is often hidden behind fees instead of normal interest language. A lender may say the fee is $15 for every $100 borrowed. That sounds manageable, but when you turn that into an annual percentage rate, the cost can become extremely high. The borrower is not thinking about annual math. They are thinking about Friday. They are thinking about keeping the lights on. They are thinking about avoiding eviction, fixing the car, or getting through the week. That urgency is what the industry depends on. Payday lending is not built around people with plenty of options. It is built around people who need cash immediately and have nowhere else to go. That is why the business is so controversial. Supporters argue that payday loans provide access to credit for people banks ignore. They say customers make a choice, understand the terms, and use the money for emergencies. And sometimes that is true. But critics argue that the product is designed to repeat, because if someone does not have enough money before payday, what happens after they repay the loan plus fees? They are short again, so they borrow again, then again, then again. This is the cycle. The first loan solves a problem for a few days. The second loan solves the problem created by the first loan. And over time, the borrower is not just paying for an emergency, they are paying for the privilege of staying behind. This is why payday lending can become a debt treadmill. You are moving constantly, paying repeatedly, but not actually getting anywhere. The industry often uses the language of convenience, fast approval, easy access, no judgment. But convenience becomes dangerous when the price is extreme. A person may borrow a few $100s and end up paying fees again and again, sometimes more than the original loan. That is not a lifeline. That is a leak in the paycheck. And the customers most affected are often those already financially vulnerable, people with unstable income, people without savings, people living paycheck to paycheck, people facing emergencies, people shut out of cheaper credit. The payday loan industry does not create all their problems, but it profits from the fact that those problems exist. That is the uncomfortable truth. Payday loans are not just a financial product. They are a symptom of a broken emergency system. If wages were higher, savings were stronger, healthcare cheaper, cars cheaper to repair, and banking more accessible, fewer people would need payday loans. But when a society leaves millions of people one emergency away from crisis, expensive emergency money becomes a business. And it becomes a very profitable one. The most dangerous part is that payday loans can feel rational in the moment. If the alternative is a late rent fee, a shutoff notice, or losing transportation to work, the loan may feel like the least bad option. That is why simply saying never use payday loans is not enough. People do not use them because they love paying high fees. They use them because pressure reduces choices. But there are still lessons that matter. First, understand the full cost before borrowing. Not just the fee, not just the due date, the real cost if you cannot repay on time. Second, avoid rolling over or reborrowing if possible. That is where the trap becomes powerful. Third, look for alternatives before the emergency happens. Credit unions, small dollar loans, employer advances, payment plans with billers, community assistance, or even negotiating due dates may be cheaper than payday debt. Fourth, build even a tiny emergency buffer. It may feel impossible, but even $300 can be the difference between a bad week and a debt cycle. The goal is not to judge people who use payday loans. The goal is to understand why the product is so dangerous. Because payday loans are not expensive by accident. They are expensive because they are sold to people with urgency and limited options. And when someone is desperate, the price of money can become brutal. This is the financial lesson. The most expensive money is usually the money you need immediately. That is why financial stability begins before the emergency. Savings may look boring. A small buffer may look unimpressive. But when trouble arrives, that boring buffer can protect you from one of the most expensive traps in America. Payday loans promise to solve today, but they can quietly steal tomorrow. If this video helped you understand the real cost of fast cash, subscribe to the channel for more clear and honest finance breakdowns. Thanks for watching.